Hi, everyone, again. This is Kathy Wood from ARK Invest. Just wanting to go through some more insights we've gleaned over the last week. It's been a very interesting week, lots of information. So first, as always, we'll go through monetary policy, fiscal policy, the markets generally, some economic statistics, and then some of our innovation company clues as to how the world is evolving very quickly here. So first on monetary policy. So now we're seeing the fruits of the Fed's policy. We're seeing money measures, which when I first started in the business a long time ago, we used to be glued to Thursday afternoon statistics because that was the money supply when Paul Volcker was around. Now no one pays attention to these stats, but M2 is up 15% year over year. Something called MZM is up 20%. So these are mind-boggling numbers. So the way to think about this is there's an equation called MV equals PQ. Now, M is money, so that's 15%. PQ on this side is GDP, prices times output, and then you have velocity. So 15%, if GDP is flat, now we think it's down, but if it's flat and we've got a 15% increase in money, then velocity is down by about 15%, basically going, meaning money isn't gaining any traction out there. Nonetheless, that does not mean it will not gain traction. So I'm paying a lot of attention to that number. It certainly means that the Fed's buying, well, quantitative easing, we're up to more than about $6.5 trillion of reserves on the central bank's balance sheet. So I think we ended 0809 at 4.5, then it started tailing off into the threes. Now we're up to 6.5, going to, we believe, 9 trillion. So the Fed is no obstacle here. Now what's happening is those those reserves are sitting on the Fed's balance sheet. They are kindling there, for loans. Now, banks have to activate those loans. They're not doing so, not in any great measure yet in terms of it getting out into the economy. But we think it will. So there's a lot out there. Now, the reason we think, and again, this is unlike 0809, it took a long time for the Feds to take more risk, make loans, take a risk on the future. And the reason was they didn't know if we were going to have a relapse. There was the sovereign debt crisis. And also, they were being regulated almost by the day. The real crackdown after 0809 was on the banks. So they were afraid of violating capital rules, and they were afraid to take risk because the economy seemed pretty fraught, especially as we were factoring in what was going on in Europe. This time, I'm not so sure. This administration is deregulating big time. And I believe it is going to work, that there are animal spirits stirring. And one of the reasons for that is fintech. So we know that, in fact, our analyst, Max Friedrich, just today called out a tweet that said, it was a small business who said, Square is the best banking experience I've ever had. In order to apply and get approved for one of these SBA loans, it took 1 day. That same merchant had applied to a bank a few weeks ago and still hasn't heard back. So I think fintech is going to start giving banks, bricks and mortar banks especially, are run for their money. So the combination of deregulation and competition is probably going to light more of a fire under banks this time. So what that 15% money growth rate suggests to me is this idea of a V-shaped recovery. This could be real. I know a lot of people have expressed doubts, but I think we're even seeing the stirrings of it now, very, very early signs. And I'll share some with you in just a minute. On fiscal policy, the fiscal relief package number 3, the president signed today, roughly $500 billion once again. Most of this going, again, to the small businesses, trying to tide them over so they don't shut down, so there's a place for these people who are not working to return and work. So I think they feel a sense of urgency on the small business side, of course. Relief Package 4 is on its way. Larry Kudlow talked about it, and he said it would include it would touch 3 areas of policy. The first, tax policy, second, infrastructure, and third, deregulation. So I think there will be more deregulation of financial services, but deregulation broadly. As you know, in order to put in place one regulation since the beginning of President Trump's administration, if someone wanted to put in place one regulation, they had to take away 2. And this has been a stealth-like, big, market-friendly positive, we believe. Deregulation will continue. Infrastructure spending, I think that's bipartisan, and I don't think that's a problem. I do think on tax policy, we're going to see that payroll tax holiday. I think that's a high probability. And we also may see some capital gains tax cuts. Not sure about that, but they had been increased under the last administration, so we may see some paring back. Capital gains tax rate cuts have been associated with strong investment activity, and we have to get investment activity going again. Capital spending has the highest multiplier of any sector in the economy, and lowering the capital gains rate, even at the margin, just taking off at the margin, the increases put in place under the last administration probably would be a boon. I don't know if that will get bipartisan support. On markets, the most dramatic move in the markets this week was what happened to oil prices. Because of what was happening in the futures market, an ETP, exchange traded product called USO, was under assault. So oil prices nearby future prices, which went negative. And what did that say? What was that telling us? Well, producers they were actually willing to pay refiners to take the oil, but the refiners have no storage capacity left. And so it was a bit of a debacle as the futures were rolling from May into June. What I found very interesting about the move is it didn't strike terror in the equity markets, which was very interesting. The equity markets this week, yes, they slipped while that was going on, and they have come back up since. I take that as a very positive sign. So what the market may be reflecting on here is, sure, this is terrible for the entire energy space. And energy as a percent of GDP is roughly 8%. But at 90% of this economy is going to see a dramatic increase in purchasing power, or in the case of business, declining costs because of this oil price reduction. So the equity markets seem to be focusing on what is positive about such a drop in oil prices, as opposed to the negative fears of systemic fallout from oil prices falling, not only here in the United States, but reverberating, of course, through the Middle East and Russia, Canada, and so forth. And we tend to agree with that interpretation. In fact, in 2016, oil prices fell apart then, and the market fell apart. And our point of view at that time is, wait a minute, this is a big increase in purchasing power, the equivalent of a tax cut for most of the global economy. And we do think it's simply the unraveling of the oil cartel. And we could see in the bond market, we also didn't see, we saw some decline in yields. We went from roughly 0.64 at the end of last week to roughly 0.6 to this week or today, but no big move. Now, this is another test. Had the markets interpreted this as a deflationary shock that would cascade and cause a vicious cycle along with everything else that is going on right now, then that Treasury bond yield would have dropped back to probably its low in March, which was in the low 30 basis point range. So here we are at 60. Now, this is still very low. At some point, I think the Treasury bond investors are going to be thinking about another $4 trillion of supply hitting them. And at some point, I believe this flight to safety that has held interest rates down, that will end. And there will be a focus on two things. One, the supply coming at them. And two, the economy stirring, if not beginning to develop some animal spirits. And then in terms of the economy, we had a number of statistics which said, yes, things are getting worse. And of course, things are getting worse. But at the margin, there were statistics which are saying, hey, wait a minute, maybe they're not going to be as bad as many people think. And maybe something is already turning. Initial claims have been coming down. Now, they're still very high, but they have been coming down for 2 weeks in a row. They have a long way to go to get back to where we started, but they are coming down. And actually, they did not peak at the 8 million rate that many economists initially thought. Instead, they peaked in the mid sixes, then came down a little bit from there last week, and now we have a bigger drop down. So that's good at the margin. Still not good that many people need to file for unemployment insurance claims, but improving. There were two numbers, though, that shocked me. One less than the other. So I'll start with the less surprising one, maybe. The University of Michigan puts out a consumer sentiment index each month. It does the survey twice in each month, once at the beginning, once at the end. So at the beginning of April, yes, so this would be an April statistic, there was a big drop from roughly about 105 to about 70, I'm going to say 77.8 in the Consumer Sentiment Index. Expectations were that there would be a further adjustment down by the end of the month to 68. Instead, it actually increased a bit, if I'm not mistaken. Yes, it did. It increased from 71 to 71.8. That's interesting. Again, everything at the margin with certainly the equity market and of course the credit markets as well. The one that shocked me, it is a volatile series, but relative to consensus expectation and what was reported, there was a wide gap. It's called non-defense capital goods orders ex aircraft. And this is the indicator I have always focused on as a really good gauge for where capital spending is going. And the expectation for this month was for a drop of 6.7%. That's sequentially, month to month. So when you annualize that, and that's like an 80% drop. Instead, we got an increase, very slight, 0.1, but pretty shocking. Now, it is a volatile statistics, but if anything, I would have expected the initial estimate to be the worst and any future revisions to be better if the economy is improving. So that was huge, I think. And it's capital spending, which tends to be a lagging indicator, except I do believe technology is so much a part of the solution to the problems we're having today that that has made all the difference. It was the more tech-oriented sectors that did so well. So again, a big surprise. Maybe if we delve into it a little bit more, we'll find, or ask the government, we'll find some special situation, which they did not describe in the release. And then I'd just like to take you through some of the earnings reports, which also were somewhat surprising. Intel, we do not own Intel. We actually think Intel will be disintermediated, especially now that the developers for Apple are going to probably start developing two open source and other programs for servers. And our James Wang, our analyst, can explain that to you. I bungled that a bit, but I think he's on Twitter on it. His name is James Wang. J Wang Ark, I think, is his handle. And you can see how we think that Intel is in harm's way. That said, it still is a very big player in technology, and of course is benefiting from work at home and digital living and so forth. And it also probably benefited in the first quarter. The revenue numbers were much higher than expected. It probably benefited because in January, much of its supply chain in China was beginning to quake because of the coronavirus in China, and certainly in February. So I do believe that that a lot of its customers, fearing supply chain issues, pulled in activity. So I do believe something like that is going on. But because of that, I would have thought that the second quarter expectation would be down, especially given everything that's going on in the broader economy. Instead, their estimate for the second quarter is revenue growth up 12%. So that was surprising. And so I do believe that maybe technology, which is a bigger share of the economy now, could be leading us or showing us the way. We saw this from Teradyne as well. Teradyne's revenues were up about 43%. 5G is a big part of it, but that's a big solution to the problem that we're having now. It's a universal robot, or more industrial automation side, which we have a big focus on that particular division because of universal robots. That was down 9%. But I would have expected a much sharper decline because some of their biggest customers are autos. So at the margin, there are some surprises. Of course, not surprising was Netflix revenue growth up 27%, with paid memberships up re-accelerating to 22%. Not a surprise. A little more surprising was Snap. So Snap's revenues were up, I believe, 44%, yeah. And the January and February, they called out as being up 58%. I mean, on fire. March was a slowdown, and they even gave us the latest week in April so that we can have a sense of what's going on. And so that would be up 11%, but still up. Now, what is the most discretionary sector out there right now for businesses as they're trying to salvage profitability? It's advertising. It's the quickest to turn off and on, especially in the digital realm. So we are encouraged by what we see there. We're in the thick of, we're the worst numbers for the economy are going to be April and perhaps May. And yet we're seeing increases in one of the most discretionary parts of the business budget. So that was also interesting. And then I'll just close on a final note. George Whitridge, who follows Zillow for us, noted that during the week ended March 22nd, that page views on Zillow were down by roughly 19%. And the week ended April 15th, they're up 18%. Now, unless spirits are lifting, if they were not lifting, people probably wouldn't be going back to look for perhaps a new home. But maybe now they're looking for bargains, and they may be getting them because I'm sure that some individuals are experiencing unemployment issues they didn't expect now. So while that's unfortunate, what is fortunate, there are people out there who are confident enough about the future to start looking again. So these might be very small signals, but I do think they speak to something here, and that is that innovation may be playing a much bigger role than even we thought. And that's the only thing we focus on in terms of our portfolios and our research. And I have always said, because I've had this experience over these last 40 years, that innovation gains traction. Its market share accelerates during tough times, during times of crisis and chaos, when businesses and consumers are so afraid they're willing to change the way they do things. And not only are they doing it out of fear this time, but out of complete necessity, because we have to work from home and we have to stay at home much more than we had to. So I think perhaps more than at any other time, any of the other 10 crises I've been through, innovation may be accelerating here at a faster pace in the middle of a crisis than we have ever seen before. And so with that, I just want to thank you once again, wish you all good health. We're seeing some hope here. It's not just spring. We're actually getting some, they might be small, but they're glimmers of light in what was supposed to be a very dark time. So very happy to share that with you. And perhaps I'll see you next week then. We shall see. Thanks so much. Bye-bye.